necessarily apply to all of our listeners, but for some of the folks who are in real estate or have an inheritance or come into a large sum of money, what do I do with the capital? And how do I protect myself from having to do ongoing obligations? Because let's say I'm commission based, I'm a sales agent, like in real estate or something, and I don't necessarily know if I'm going to keep making the same amount of income year after year. That's kind of the question we have with people is like, hey, I want to commit to this, but I don't know if I can keep committing to it in year two, three, four, and so on and so forth. So that's their concern. So what I did is I front loaded this. I did a large lump sum. When I say lump sum, we're talking about $500,000 split between the husband and the wife, $250,000 a piece. And they never funded it again because the carrier that we like to work with actually has what's called a premium deposit fund.
Welcome back. I know you missed us, and we're back. WealthWise Banking. Jason Sipple down here in the city beautiful, and here with my all-time, one and only favorite co-host, Mr. Jeremy Lee Huggins. How you doing, Huggy?
Yeah, no,
Wait,
man, I'm excited. I'm glad to be here. It feels like I haven't talked to you in a week.
it has been exactly a week now that you're flying all over the world again. You were in some pretty incredible places. We had some off-air questions for you that haven't been asked yet, but I saw one beautiful picture. Why don't we share with the folks? Where were you?
I was down in Antigua. It was a work trip. So we have a resort that they put us up in, and it's funny because I'm there for work, but I still had three client calls, so I have a hard time unplugging sometimes.
Ooh, we're going to get into that a little bit too, but what are we going to get into today? What are we talking about today with our fine builders that are listening?
Yeah, so today I was given a problem set with some high net worth real estate investors that I work with. And their question was, hey, Jeremy, I've got this money sitting in this money market account, earning me basically 2% and change, and I want to put it to work. What can I do? I like this policy idea, but I don't want to keep funding it every single year. So what can you do for me? And this is where I love to get into the weeds of it and the mechanics and built out something that was literally a single pay premium so they could have a banking policy that would continue to work and compound with them. And they only had to ever contribute to it one time, and we didn't break the freaking bank, and it's not taxable.
Mm.
So, yeah, we'll get into it. It's pretty cool.
Yeah, it's incredible. I love how every time that there is a new problem to solve, you're able to come up with a new solution. Now I have stored that away in my brain, so when I have that couple come in front of me, I know where to go, right? And anyone listening, now you know where to go. So we had a problem. Jeremy came up with a solution. We're talking about money that's sitting around idle, right? And lots of money in some
Yeah.
cases. So
And like, where does money come from, right? I said that they were real estate investors, but these large sums, they can come from things other than investments. It could come from an inheritance. It could end up coming from like selling your personal residence. It could come from long-term savings, right? Most people just have that money that kind of sits in the account. Warren Buffett has a mass amount of idle cash just sitting there for when the market's tanking and capitalize on opportunity. We've talked about luck before, preparation meets opportunity. That's what luck is. So that's what this is focused on today. Is like, how can I get more my money to work for me? How can I actually get it from stop being idle and actually put it to work today?
and how can we get it out of a situation where we are actually not in control, right? Versus now we control what's happening and we have guarantees.
hmm Yep. And getting back into the basics, like you asked me a question before we started, but it was when your money typically, when you get paid, it goes into a bank and who controls that, right? That's what you asked me. And what did we talk about? Like getting back to the basics a little bit before we go into this.
Yeah, and when you as soon as you deposit your money in the bank, like especially if it's automatically deposit, you might think, "Hey, I have a lot of money in the bank." Guess what? No, you don't. You no longer own and control that money,
hmm And why
right?
is that though?
Well, tell the people, Jeremy, like why is that? As soon as they have it, what happens with the money? And why
It,
don't
well,
you?
it goes into deposit, right? So you become a depositor, and now the bank owes you 0.01%. That's what you get for them to be able to go and lend out your money 10 times in the fractional reserve banking system that we have here in the US. But it's not your capital. It belongs to the bank. You think it's yours, but it's not.
And yeah, and then there's other things we're going to get into to consider, but we just want to show you right away where you've been taught that that is what people do, what you do, And if you start asking the question, who does this serve? Who actually is winning from the hard work we go out and earn money or receive money and we deposit it, like Jeremy said, you become a depositor and you no longer control it. So,
Mhm. So, looking at where people typically hold large sums of money, right? The meaningful amounts, we go and look at things like money market accounts. We'll look at a high yield savings account. I think you said someone puts money in the mattress if they're listening to who, right?
oh no, I said, hey, don't forget to put it in your coffee can and bury it in the yard if you listen to Daddy Dave or Susie. So,
Yeah.
you put it in a safe, and we do these things because one, we want to feel certain. We want to feel whole. We want to have access, right? But the feelings we're looking for are certainty, control, and then it's because we want access, we want flexibility. You want to feel like if something happens, that you can get it if you need it.
Yeah. And what's that actually doing for you, right? If you stop and kind of think about it, what's that money doing when it's just sitting there?
Oh, well, it's doing what you just said. It's sitting there. And in today's market, when you start looking at what the banks are doing with our money, well, the money that used to be ours,
Mhm.
we start seeing that because of fractional lending, right? Inflation's going through the roof, like everything's getting more and more expensive. You start looking at the amount of dollars that have been printed over the last, what, few years, right? The last 6 years, trillions of dollars. And now that money that you have sitting there, it's what's happening to it, Jeremy. Is it getting more or less valuable every day?
It's getting less valuable because of inflation, right? That's kind of the thing that's eating away at it. But at the same time, other people have the fear of, well, if I put it into this investment or if I put it into that, I might incur another obligation. And that's why you see people kind of like create these peace of mind funds because it is peace of mind, but at the same time, is it really getting the most efficient work? I want access, I want flexibility to your point, but I might get better returns if I put it somewhere else. Or am I just creating another obligation? And that's where people kind of start to get stuck, right? They believe that there's this choice about leaving the money or committing it. And what we found, or like going through this kind of case study and working with these new members, is guess what? You can actually have freedom, you can have flexibility, you can have control, and you don't have to take on commitments and continuing obligations. We can actually structure this in a way that's healthy and avoids the taxation. We get Uncle Sam out of our pocketbooks.
Not only do you get them out of your pocketbooks, you also give yourself, like we all say, hey, we work hard and we got to work smarter, right?
Mhm.
Well, can we have our money work smarter? And what you uncovered today, what we're going to share, shows people that yes, you can indeed work smarter, even if it's just a lump sum and you want to be one and done, like you said, right? So, but the question, we were talking about money being in a bank, money being in these other places, in cans, under mattresses, all these different places. So, what's the question, right, that leads someone down this path that we're kind of exploring today?
Can I get a better or higher use of my money? Can I actually put it to work? Can I get control and flexibility without committing it necessarily? And so that's what we had to do is we had to figure out a way to get the same benefits that we like to use in the policies that we design. And for anyone who's a new listener, we, myself, Jason, and many of our other listeners, we like to use whole life insurance as our banking system, right? If that doesn't make sense to you, now might be a good time to actually pause, go listen to some other episodes, and then come back. But we use it for the guarantees. We use it for the control, for the flexibility. We'd like to earn capital while at the same time moving it for opportunities as well as having it there for emergencies. The problem is that, or for some people, they'll view it as a problem as ongoing premiums, ongoing obligations. And so they'll shy away or they'll underfund these policies, right? And that's why you see people with multiple policies. They'll go, oh, I'm going to throw out a policy and I'll throw out a tester amount, see how it actually works. They'll come back to us typically 6 months later and create another policy. How many times have you seen that, Jason? Right? Where they underfund.
Yes. Well, yeah, if they I call that dipping our toes in the water, Jeremy. That's someone who hasn't yet had enough belief, right? It's like Henry Ford said, you've heard me say this before, you either think you can or you think you can't, and either way you're going to be right. So sometimes you have to prove to yourself, like you have to do the thing to feel confident. So someone might start small, kind of underfund it, and all of a sudden they're like, oh my God, It happens exactly like Jeremy and Jason said. This is the best thing ever. I wish I knew about this when, Jeremy.
Yesterday, 10 years ago, I wish my
20,
parents
I
knew
hear
about it.
20, 30 years ago is what I hear all the time. Like, depending on how old the person is, I always hear some large number, and I'm like, yep, but when's the second best time to plant a tree, right? So,
Yeah, today. Yeah, fair enough. I hear typically I wish my parents knew about it. All right. So that way, because a lot of us are generation one, we're all starting out. If I mean, imagine the benefits, like Connor, as an example, your son coming in as generation two and what he's learning and how this system is going to continue working for his children and so on and so forth.
well, it's incredibly exciting when you have that gift to be able to share that with your kids. We have my oldest. You mentioned Connor, but now I've got my Marine, right? That he was asking me about it the other day, Jeremy. He's starting to get excited about what's coming for him in the future. So let's go. You talked, you opened up, you got people curious. You had this couple, this real estate investors who had their money sitting in a high yield, actually a money market similar to a high yield. Let's kind of share what this structure looked like and kind of what the problem was and what they wanted and how you helped them solve this problem.
Let's get into their unique situation, right? Because this isn't necessarily apply to all of our listeners, but for some of the folks who are in real estate or have an inheritance or come into a large sum of money, what do I do with the capital? And how do I protect myself from having to do ongoing obligations? Because let's say I'm commission based. I'm a sales agent like in real estate or something, and I don't necessarily know if I'm going to keep making the same amount of income year after year. That's kind of the question we have with people is like, hey, I want to commit to this, but I don't know if I can keep committing to it in year two, three, four, and so on and so forth. So that's their concern. So what I did is I front loaded this. I did a large lump sum. When I say lump sum, we're talking about $500,000 split between the husband and the wife, $250,000 a piece. And they never funded it again because the carrier that we like to work with actually has what's called a premium deposit fund.
Let's
Think of it
pause.
as, yeah,
Pause there. Okay, pause there because this is one of the mutually owned dividend paying companies that we love working with. Not every single one of these companies that support ICBC does this. That lets us do these specially engineered policies. But when you said, like, people might have heard you, because this is what I heard. They did a single premium that did not become, you didn't say this part, but it did not become a modified endowment contract. It wasn't a taxable event contract. And that's typically not been the case since 1988, right?
correct.
So because of that, I just want you to pause and give more context to what you did first and why.
So I designed something based on their health, based on their age, their gender, that allowed it to actually accept $250,000. Now, that $250,000 sits with the insurance carrier. And what it's doing is now funding the policy for the next minimum 7 years. I could have it fund for the next 2 years or 3 years. The thing is, I wanted 3 or more years. Why? Well, when you give the 3 more years of funding, what we now have it doing is acting like a high yield savings account. So it's currently earning 5.25%. That's what it is today. It's earning 5.25% every single year, much better than the money market, much higher than any high yield savings. It's also there as liquidity. And then because the policy, this fund accepted it and is giving them 5.25, well, those returns, that 5.25, also goes not just into the annual premium every year, but that percentage, that interest is also going. So they're actually overfunding the policy by 5.25% every single year.
Hmm.
And then I design it to stop payments altogether starting in year 8. So now think about that. They have ongoing dividends for the rest of their life, compounding cash value for the rest of their life, compounding death benefit for the rest of their life. They're moving into their retirement years and they're basically getting a whole nother rental property per couple just based on how the policy designed. So what I did is I basically accepted all the capital up front. I allowed it to be there for when they need it. It's clear, it's accessible, it's part of their net worth. It's on their balance sheet. It goes towards their assets column. It's earning 5.25%, and it's actually paying off the premiums every single year for the next 7 years. And again, I could have it due for 2 years, I could have it due for 3 years, but I chose three or more in order to get that 5.25, which is more than doubling the money market that they're in right now.
And along with that, in the money market, those gains are what? Those gains are taxed. So when it comes out, right, when you're using it, it's going to be taxable income. In a policy, Jeremy, it's tax free.
Mhm.
TUSAM is out of your hair, right? I think it's really important to really start thinking through and they control it. If the money's just sitting there liquid, right? You said it's on the balance sheet. Like if the banks need to see it, guess what? That is one of they look at it, say, hey, how much cash do you have liquid? And the next thing they'll say, hey, do you have whole life with cash value? Like
Mhm.
that's a second thing when you're going to the bank to try to collateralize something, and they have that now, right? You set that up for them.
Yeah. Now, here's the cool thing too, because typically we say that when you fund one of these policies, the first couple years are the hardest years, right? You don't get the dollar for dollar match. And that's true in this design for the first year. Basically, they're actually getting 90% of the premium from the first year available in cash value.
Hmm.
But I didn't design it for 10% base, Jason. No, I actually designed it at 36% base. So it's a very, very healthy structure. It's not going to collapse on itself. It's a 36% base, meaning that it's not going to collapse. It's not going to cannibalize itself. How's that growth happening? It's happening because of the way the PDF and that interest plus the dividends all coming into play. So they're actually getting more than 90% cash value available in the first year.
Wow.
In year two, check this out. Year two, the PDF is funding the policy, but the increase in cash value is greater than the annual premium. Think about that. So we've already hit efficiency by year two, meaning the annual increase in cash value exceeds the premium that goes into paying in year two. That just continues compound for the next, what is that, 6 years until year seven. And then in year seven, there are no more. The PDF funded the entire amount. The policy now requires zero premiums, which means the dividends and the compounding growth are automatic for the rest of their lives. They never have to worry about funding it ever again.
And the PDF is just a high yield account that the life insurance company has. So the money goes and sits there, and then it's directed to fund the policy. Just for
That's right.
everyone who's maybe not tracking, right? Because this is newer stuff. This is new territory, new problem, new solution.
Yeah.
So
So that was plan A. I also built it, Jason, for plan B, because what if you wanted
why?
to?
Because you're military and you love contingencies, brother. This is what you
Yeah.
do.
So what if you wanted, like now let's ask the question, well, what if I wanted to continue funding in year 8, 9, 10, and so on and so forth? Well, I did. You can actually build it to where I allowed the policy to get cheaper over time. And what we're doing is allowing a portion, like the dividend, to actually fund the premiums. So the policy is now going, we can go upfront where there's safety and security, but the second path allows it to keep growing, right? So now I have optionality. I actually get more cash value. I get a higher protection, more death benefit, and option B. The question is, well, do they want option A, which is guaranteed because
Mhm.
dividends aren't guaranteed, even though they've been paid up for over 100 years straight? They're not necessarily guaranteed in plan B. But if they want plan B, I built it to where they could do either or. So right now, the structure that they're kind of leaning is we're going to do plan A on the husband and plan B on the wife's policy. So they're going to mix it up a little
Wow.
bit.
I must have flipped a coin and got different results. That's pretty cool. So they're kind of going in one and going in the other and doing both. And I always think that, when people aren't thinking or prioritizing long term, right? Long term output, like you're talking about with option B, correct? That it's partially us as their mentor, as their guide, to help them not only solve the problem in the present, but also help them set up to have the options, right? I always ask people on my calls, hey, if you believe what I believe, the wealthy have more choices. Is that fair? And I've only had a couple people who are super thoughtful say, I don't, maybe. But everyone else is like, yeah, Jason, absolutely. Well, what you're doing for this couple, Jeremy, is you're giving them more options, whether they want to stop after year seven, keep going, how they want to do this, right? Like that's what I'm hearing you say.
Yeah, and I know this is kind of a mechanics, and this is I I guarantee you we're going to end up getting questions from the other producers, the other IBC practitioners on how you build this out because this is not common. Building this out, it's there's no one that's teaching this, right? You actually have to go through, spend the time with the software, figure out the mechanics of it, understand how the carrier works. And I know that this sounds like a lot like a mechanical conversation, but really, if we get back to the basics, the question was, how do I get more use out of my money? How do I still have control? How do I get flexibility? How do I fund this? How do I participate in this banking system? And I only participated in it once, but it gives me a lifetime benefit. It gives me lifetime control, lifetime flexibility. For those of you who want to understand how to build this, go ahead and call us. Go to wealthwisebanking.com. If you see this as like, hey, I'm a commission person, I want to be an IBC practitioner, I want to be someone who's involved in becoming my own banker, but I don't necessarily know my income is going to be next year. I can participate in this in year one. We got a way for you. We can build it out. We can show you how to do it. I just mentioned $500,000 for this couple. You don't need $500,000. All right. You can go much smaller. We can build out what I say is meaningful, what's manageable. We build it out customized to you. If you have a large lump sum, obviously it works better. But that doesn't mean that you can't work off of something smaller too. This does apply to everyone.
I love it. I love it. And now that we're getting towards the end, wrapping up, is there anything else? Because again, you just goes back to the question, am I in control of my money? And if it's no, how could I be? And how could I have my money do more things for me, right? How could I have my money working harder for me? And if you want to know how, Jeremy, let's tell the folks. You already mentioned go book that strategy call and WealthWise Banking. But anything else you want to kind of give to the folks before we wrap this one up?
No, I mean, we'll look at what your setup is like today, what your options are, whether this structure even makes sense, right? Like I said, this doesn't necessarily make sense for everyone. The investors of the world, someone who's coming into an inheritance, that is where this strategy makes sense, right? The people who have liquid capital. This is for the people who implement the laws of wealth, right? Where what do we say is law number one? Pay yourself first.
Pay
If you've
yourself
been
first.
doing that for a while and you have built up an emergency savings, a peace of mind fund, this might be the place where you take that, you put it into the policy, we allow it to pay for itself over time, and now you just lock it in, you set it and you forget it. After this, my inspiration, in full transparency, this is what my next policy is going to look like. I am going to build my next policy exactly like this. From the 6 policies I already have in place, not one of them is designed like this. You can rest assured my policy is going to, the next one I build this year is going to be built just like this.
Now that's a fun way to wrap this up. And we have 5 family policies ourselves. And I was talking about this earlier on a live Ask Me Anything, and just saying that they're all built differently because they all solved a problem in that moment and they all have considerations for the ongoing long term, right? And that's what you're saying. Like I already know without even asking you, you have jobs and why you would do this.
Yeah, yeah, correct. Like I practiced the laws of wealth. I was able to build up a large pool of capital. I need a place to put it, and I don't necessarily want to worry about continuing to fund this because I already have other policies that got to get funded every single year. So this is going to be my one and done. I'm going to build it out for myself, and I look forward to being able to build it out for other people. So this is exciting.
Yeah, it's super exciting. When you come in learning something new, man, I'm always pumped up. And we already know we're already in banking.
You're just not the banker yet.
All right. See you all in the next episode. Be blessed. See you soon. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.